We are not going to make lots of friends with this video, especially in the YouTubers that are selling you affiliation links to gold brokers or information on gold management. I just share with you freely my findings. My name is Rana, I'm a researcher in Europe and you are watching the Crypto Post. Let's be clear, the long-term history and performance of gold do not indicate that it's a good inflation hedge. Let's define what is inflation for newcomers. To put it simply, inflation is the rate of which prices for goods and services increase across an economy. In other words, if the price of your bottle of Coke goes from $1 to $1.20 from 2021 to 2022, you will say that there was an annual inflation of 20% of this item. Inflation, generally speaking, takes the price of a lot of different things, not just Coke, for a given country. Of course, it's a mean value. Individual things can have increased much more or much less than the mean value of inflation. Now, what is an inflation hedge? In a perfect world, if you put your fortune into an inflation hedge, for example in 2021, it means that whatever happens in terms of inflation in 2021 or 2033 or 2050, you expect that your fortune remains intact. Your fortune should not be eaten away by some inflation. It should have the same purchasing power now and any time in the future if you buy an inflation hedge. In other terms, you would expect that your fortune remains flat over time if you take into account the inflation. So if you understood well, to know if something is a good inflation hedge, you need to look at its price throughout time, but being adjusted for inflation. What is adjusting for inflation? It sounds complicated, but it's conceptually simple. We all know that the purchasing power of $1 has declined throughout time. Roughly, in terms of purchasing power, you could buy in the early 19th with $1 as many things as with $20 in the early 2000s. This is due to inflation. Well, when you adjust for the inflation, you don't just take the price of gold throughout time, but you also take into consideration the decline in the purchasing power of the dollar itself. And then the price graphs of gold start to look really different. So the graph here is with the inflation measurement protocol that was used until 1980, so before it started to be manipulated by the government. So now if you look at the graph, you look at the price of 1 ounce of gold nowadays, it's equivalent to $1,800 in purchasing power. But if you go back in time while taking into account the decline of purchasing power of the dollar, you will see that the real price of 1 ounce of gold was up to $12,000 in 1980, so about 6 times more. Let's phrase it differently. If you bought 1 ounce of gold in 1980 and kept it, you will be able now to buy around 6 times less with that ounce of gold compared to when you bought it. A 1980 gold buyer has his fortune divided by 6 in 40 years. If gold were a good inflation hedge, your fortune would be intact. This graph will probably be really surprising to a lot of you. Most people do not look at the price of gold adjusted by inflation, but if you did, you probably looked at the price adjusted by the real inflation announced by the government. However, the inflation numbers given by the government are totally underestimated. They have designed and changed the way they used to calculate the inflation multiple times throughout the decades, up to the point that some economists will even tell you now that it's cooked, it's a fraud. Stay tuned, I will also do a video on this scam and how governments are lying to you by using totally wrong inflation values and why they do this. But really quickly, if you are new to the channel, make sure to subscribe if you enjoyed this video, then hit that like button and leave a comment for the algorithm. In addition to this YouTube channel, make sure to check thecryptopost.com and you can support me on my Patreon and my OnlyFans that are in the description. I am sharing exclusive content there, like ways to earn up to 50% interest per year on your dollars in crypto. Sure, now you could tell me gold might outperform the inflation nowadays, just like during the 1970s. That's true. But then you need to acknowledge that you are buying gold as a speculative asset and not as an inflation hedge. Trading a speculative asset is a different game. It's almost impossible to time the market and buy gold when its price is low and sell it when it's high. That's why I'm here presenting you the long-term data. If you look at the price of gold adjusted for inflation, if you try to sell gold that you bought any time after the 1980s, you have lost part of your fortune due to inflation. Has proven, historically speaking, gold does not beat inflation, and in fact it does not also beat hyperinflation, as we will see in the next video. The script of the hyperinflation video is already available on our Patreon. You can check it. Fundamentally, why is gold a bad inflation hedge? Warren Buffett pointed out gold is not a productive asset. In addition, the value of gold is the result of many macroeconomic parameters from bond and currency policies and is linked to the value of the dollar itself. All of that render gold too volatile to actually be an inflation hedge. I know there is some religious belief around gold, but the fact is it does not procure any value in itself to have gold. What about gold mining companies? They do produce values and so dividends. Well, it's not that glam right now. The ETF GDX covers the value of different gold miners' stocks since inception. What is an ETF? It's simple. An ETF for exchange-traded funds. It can be understood as a passive tracker of an index. When you buy a share of an ETF, you have a stake in the basket of investment tracked by the ETF. There is no active management like in a fund, and the entry cost for investors is minimal. Generally, you compare the performance of an ETF to the S&P 500. S&P stands for Standard & Poor's. The S&P 500 is a stock market index based on the 500 largest companies listed on stock exchanges in the United States. The GDX ETF was created in 2007. Compared to S&P 500, the ETF GDX is down 20%, while the S&P 500 is up by 260%. Also, that's over 13 years. 13 years is almost a third of one's investing career, if you are lucky to be able to invest for 40 years. It's a massive failure. So as you have seen, gold is too volatile to be considered as a good inflation hedge. But honestly, most of the things are not a good inflation hedge. Everything is risky and has to be treated as a bet, and God knows what will happen. This is why altogether the famous Black Swan author Nassim Taleb do not recommend having more than 5% of your portfolio in gold, and you should consider this 5% as nothing more than a special insurance, just like having a gun at your place or just like holding Bitcoin. Don't fool yourself that it will beat inflation. It will not even beat hyperinflation, as we will see in a video very soon. So how much gold do you have in your portfolio and why? Let us know. The more knowledge you are able to gather, the more we will be able to help you. So please share and subscribe, like and comment this video to spread the knowledge. We are currently doing this channel on our free time. You can support us on my Patreon. This will help us hire people to help us on the video editing part, and we will be able to produce faster videos like this one. We also post some exclusive content on Patreon, so make sure to check that out. Down in the description you will also find links to my favorite broker eTORO, where you can trade stocks, crypto, commodities, currencies at zero commission. You will also find a link to Binance, my personal favorite exchange by far, and BlockFi, where you can get up to $250 in free Bitcoin and earn as much as 9% interest per year on your stablecoin. You might also be interested in this video. We stay in touch on Instagram and Facebook.